Hello and welcome back to Know Where to Invest. I'm Robert Sadler. I'm the founder of Know Where to Invest, and this is the 8th video in a series in which I cover the challenges of knowing where to invest during economic crises. Now, in this particular video, I'm going to be addressing how you can use technical analysis to figure out where to invest and earn, hopefully, an active and positive return. And by the end of this video, you'll know full well if technical analysis is the right route for you to take. Now, the first question I suppose you might have is, what is technical analysis? Well, much like as it sounds from the name, it's a very technical field, and for many people that may disqualify you. But it's good to know that up front. So essentially, technical analysis is a trading method in which you evaluate investments by analyzing statistical trends which are gathered from trading activity, such as past trading activity, such as price information and volume. By volume, we mean the number of trades that take place over a period of time. Now, what a technical analyst is looking to do there is look at these trends and try and tease out patterns and determine when is a good time to buy and when is a good time to sell. Now, you can use technical analysis for a number of different types of investments. Commodities is popular, such as gold, oil, corn, so on and so forth. FX, foreign exchange trading, for various currencies, trading pounds, euros, dollars, so on and so forth. And more recently, people are using it to determine where and when to invest in cryptocurrencies. Now, the issues with technical analysis are such that first of all, you may already be picking up on the fact that it can be quite complex. We're talking about statistical trends, and many of us are not going to have a deep statistical background that allows us to easily analyze these trends. However, there are many platforms, software platforms, for example, that are usually attached to online broker platforms or in apps that can assist you here and actually do the calculation for you. Or you might be like one of my friends who's built his own algorithm and he's using that to determine how and when to make trades. So, what are some of the common problems with technical analysis? Well, there are all sorts, and so one that perhaps maybe many technical analysts may not agree with is that there's always a behavioral component to this, or an emotional component. It may not seem like it because you're using numbers and statistics and so on and so forth, and you're making your decisions based on that. However, there are a number of I think as many as 100 different types of signals and techniques and things that can be used with technical analysis, and so you've got to decide which one to pick and then also how to interpret it. So to give you an example of one of the issues that one of my friends has run into is that his algorithm will give him a sell signal, but sometimes the stock will continue trending upwards in price. So you don't really want to sell your stock at that point, but the algorithm has given him a sell signal. So how do you deal with that? Well, it might just be that the particular algorithm is breaking down for that particular investment. Maybe there's some issues with the algorithm, or maybe it's just that it's not always possible to determine how a stock or how an investment is going to trend simply based on past information. So how do you deal with that? Well, one way to deal with that problem is to spread your trade. So maybe don't go all in all at once, but maybe put in, in this particular case when we're looking to sell, maybe sell a portion of the investment, see how it goes. If it continues trending up, maybe you can disregard the sell signal. But if it starts trending down, then maybe you did the right thing. So it's a way of sort of almost balancing or diversifying a little bit how you're processing this trade. Another issue that people have come across with technical analysis is that if you consider the fact that it's picking up on trends can change very, very suddenly based on unusual and unanticipated events. Now, when we say an event is unanticipated, that means that it's very unlikely that that you're going to be able to determine that it's going to happen ahead of time simply by using statistical analysis of historical prices or volume of trades. So, what do we mean by unanticipated events? Well, perhaps something comes to light where a company has been doing something fraudulent or illegal. So what's an example of this? Well, Enron. Many people didn't see the collapse in Enron, and this was about 20 years ago. And Enron was a energy company in the United States. Fraud came to light quite rapidly. The stock price took a tumble, but not just Enron was impacted, but also their accounting company, Arthur Andersen, was also impacted. So when this kind of thing comes to light, and it can come to light in quite a dramatic way, it can be very difficult for your trend analysis to pick this up, because your trend analysis has built a trend based on what's been happening in the past. And of course, the past doesn't incorporate future unanticipated events. What else can happen? You can have market manipulation. This happens from time to time when investment companies get together and build a sort of cartel in which they will plan to change the price of something, of an investment, of a stock, or of currency ahead of time and together, and this will again not be picked up by your trend analysis. Now, companies do get fined for this kind of thing, but it seems that this kind of thing just goes on and on and on. The other thing that can happen is large investors can get hold of insider information, perhaps, and again, it doesn't always come out. It's a difficult thing to prove. So if a company has insider information, this is information that's not publicly available and is probably not going to be built into your trend analysis. So once again, your trend could be saying buy, or giving you a buy signal for a particular investment. You go ahead and buy, but some institutions got wind of something early on. They've done a big dump of the, let's say, stocks. They've done a big dump of the stocks in the stock market, and the price goes down. And the result you were hoping for doesn't occur. So how can we deal with this issue of an unanticipated event? Well, it's again we go back to the concept of diversification. Where you give up some upside to reduce your downside. So perhaps if you're looking at a number of investments, a number of stocks, a number of currencies, or a number of different commodities, or maybe you're looking at all three, well, then you're insulated from a dramatic event impacting one of those investments. So hopefully they wouldn't all get impacted at the same time. This is a possibility. Or you can spread your trades over time, as I indicated before with the earlier issue with the incorrect buy or sell signal. So if you're spreading your trades out, then once again, you're insulating yourself from the possibility that you may have either incorrect information coming from your trading model, or from a unexpected and unanticipated event. Now, how do you get into technical analysis? Well, there are a number of different ways to do it. Now, if you've seen the rest of my videos, you know anything about me, I always counsel people to take their time and get to learn how to use a specific trading approach. So if you've decided that technical analysis resonates with you, and maybe if you're sort of mathematically inclined, it probably will. Or if you're, you like to look at data. Some people are like that. Others are not. This is why some people get into real estate, because they like to be able to see the bricks and the mortar. But other people are more interested in the numbers and the data, and they find that thrilling. If that's you, then technical analysis might be for you. It might be worth taking a closer look. And so usually the first step I would say to people is educate yourself in how technical analysis works. Really get to know it, because by going through this process of education, you may find something else about it, and maybe you decide at that point that it's not for you, or you find that it really is for you, and now you're that much more enthused, and you're going to spend a bit more time on the preparation and learning how to do it. Now, you can look at books on technical analysis. There are many. Authors to look for are John J. Murphy and Jack D. Schwager. These guys are well known and have written some very good books on the topic. And then you can also look into online training courses. There are many of these things. What I will say, again, to be careful of, is that there are, and this happens in almost any sort of field in which you're trying to learn how to make money. There are always charlatans. So you've got to watch out for these people. And I would say, look out for people who are offering you an expensive course with no, that promise extremely high returns, which obviously they can't guarantee. No one can guarantee what your performance is going to be like in any given trade. So watch out for those sorts of things, and also watch out for people who are providing trading courses but don't give you a money back guarantee. If you get, and I've seen this, I've seen some expensive trading courses in technical analysis where you pay for the course and you're stuck with it. You might take a look at the first couple of modules and you might think, no, this isn't for me. But you've already spent your $400, $500, $600, $1,000 on the course, and this person won't give you your money back. In fact, I always say that's a red flag. If somebody's selling you an expensive course and there's no money back guarantee, it's a red flag. Because if this person believes in their course, then they'd be happy to provide the guarantee because they'd be so confident that you're going to get something out of the course and that you're not going to want to get a refund. It's always something to pay attention to. And then, of course, once you feel like you understand how technical analysis works, then you're going to need some sort of platform. Now, as I said, one of my friends is building his own platform, but if you're not technically inclined in that way, there are existing platforms out there. Most of the big broker companies have platforms available online, and by those, and of course this is not a recommendation, just information, but Charles Schwab, Etrade, Fidelity, these guys all provide online platforms that you can use to get involved in technical analysis trading. Now, what I really want to underline here is that technical analysis is not a shortcut. Buying a platform or getting access to a platform is not a shortcut to earning massive amounts of money, or getting you to retire in 2 to 5 years or anything like this. Like all of the disciplines that I've mentioned, when it comes to earning let's say an income that replaces your current income on your job, because this is what we're looking at when we're looking to get into some sort of active investment, there's no shortcuts. You've got to work hard, so you really want to make sure that you pick an investment style that resonates with you, but also is one that you're prepared to put in the time and really get to grips and learn how to use it. Because it would seem to me that the key to success with technical analysis, as with any other trading approach or investment approach, is practicing and developing a sixth sense, knowing when to disregard the signals from your analysis that perhaps don't really make sense. You may not be sure why they don't make sense at the time, but sometimes, I hate to say it, you have to rest on your gut instinct, or your understanding of the market, your understanding of these investments, which is probably a better place to go than gut instinct. But people argue back and forth about whether you're using your gut instinct in investment is a good thing or a bad thing. But you want to think through twice about your investments and make sure that you're really making the right decision. This is why I always encourage people to have a framework behind their investment. And if you're choosing a style of investment that you truly understand and you understand well, then you're a lot less likely to make mistakes. So this again is why I say take your time, learn how technical analysis works, and make sure it's for you. And then, practice it, and it will take some time, but eventually you'll understand how it works, you understand how the markets work, you understand whether the buy signals, the sell signals, and all these things make sense. And then, hopefully you can make some good returns out of it. Now, as I say, I see technical analysis as an active investment, which it is, and it sits in the framework at the top the top of the pyramid. So I've outlined 3 levels to the gold priority pyramid. Now the bottom level is the emergency fund or on-hand portfolio, and that of course is where you will have investments that you can use in case of an emergency, such as a loss of a job or a loss of income due to reduced sales or clients due to perhaps an ongoing economic crisis such as the COVID-19 crisis of 2020. And you've got your second level, which is your retirement, and that makes sure that when you are either unable or you've reached a point in your life where the retirement portfolio is large enough that that you can stop working full-time, then you've got that taken care of. So if you have these 2 levels taken care of, then you can consider the more risky but potentially more lucrative investments that belong in your aspirational portfolio. So this is where I see technical analysis right at the top of that pyramid. Active returns. Basically what you're doing here is you're building a business, and business, it's you're going to put a lot of effort, a lot of time, and perhaps a lot of money into one specific mode of investment or one specific business. So you want to make sure you've taken a prudent approach to cover the bases first. Make sure you've got that foundation. Then you can start to look at these slightly riskier options. But of course, with the higher risk comes the higher payoff, and that's why we put that at the top of the pyramid. All right. Well, I want to thank you for watching my latest video. Remember to subscribe, and if you like the video, please make sure you like the video. Hit the bell next to the subscribe button so that you can be notified of my future videos. And also, as I always tell you, I have a free book that I provide to people. The link is in the description if you want to get hold of this book. And also, you can get a free email course which will be customized to your specific investment challenge, which should be very, very helpful for you. So thanks again for watching, and I'll see you in the next video.